Hey, without any further ado, I want to introduce y'all to Jim. He's a senior wealth advisor here at Aspen, um, and just does a phenomenal job. And he is just a subject matter expert in so many different things. And one of the things that he's passionate about is this year-end tax planning. And I know it's about this time that we really start to look at our clients' accounts, but we wanted to share some information with clients and just make you aware of some opportunities that are out there before the year end comes.
Awesome.
Okay,
Thank you so
that's
much,
all I need.
Candace. Well, I have to give compliments and praise back to my colleague Candace. She's our director of financial planning and is an absolute rock star, a member of the team here at Aspen. So thank you all for joining us today. The purpose of this webinar, it's pretty much in the title, year-end tax planning essentials. So this is the time of year when we at Aspen and our calendars get pretty busy, because we want our clients to know, kind of in September, October, November, what their estimated April tax bill is going to be. There's nothing that hurts worse than like when you maybe have a change in income, or maybe you change jobs and there's something that is a little off with your withholdings, and you go to file your taxes and then you get a surprise of the big bill. So what we want to do for this webinar today is just kind of go over some year-end tax planning essentials, um, and maybe how this flows through to your account. So we're going to cover a lot of things. We'll talk at a high level of like how tax planning works and how it often kind of rears its ugly head for a lot of folks, and why we believe it's important for our clients. But then we're going to walk through kind of the following key areas. We're going to start at a high level, understanding how the marginal tax system works. I think before we start talking tax strategy, we need to kind of set a healthy framework of like, how does our tax system operate in the first place? Because once you understand the rules of the game, then you can actually kind of play alongside of it and hopefully to your advantage. Well, after the kind of breaking down the marginal tax system, we're going to maybe incorporate how this works within your financial plan and contextualize it a little bit. Then we're going to talk about how to determine your brackets or where you kind of fall before the year end. So you can do it yourself. We can help you, or you can work with your CPA. But after this webinar, my challenge to you guys before we even get started is over the next few weeks, I want you to do your best to figure out if you can estimate what your tax bill may be in the spring, and if there's anything you can do between now and December 31st to mitigate that. So with that being said, the next area we'll cover are kind of strategies to help mitigate your taxes, and we'll go over a handful of those. And then I think I wanted to, it'd be helpful to bookend it with a few examples of different strategies and different ways they'd actually help a couple kind of case study clients. And so it's a really informative webinar. We're going to start at a high level, again, with the tax system, and hopefully that kind of sets up a good framework for how that will flow through to your personal return. And that, again, like Candace alluded to, there is a chat section and there is a Q&A section inside of Microsoft Teams. Feel free to use those. You can also toggle on your mics on and off if you want to stop and ask questions, but we have bookended the last 10 to 15 minutes of today's presentation specifically for questions that you guys have. And I know we've already fielded a handful of emails with questions in advance, so thank you for those who have sent those over. So let's go ahead and get started. All right. If I can figure out how to use PowerPoint. All right, so what is the difference between tax planning and tax preparation? It is not uncommon for us to get an email or an inquiry or a phone call somewhere in April or March with someone who says, hey, I got this huge tax bill. Can you help me with it? And oftentimes it's like maybe an employee who's worked their way up through the ranks and they started getting stock options, or they started getting bonused a certain way and they had an influx of income, which is a great problem to have. But it's their first time kind of getting hit with a large April tax payment. And so their question is pretty simple. Like, what could I do to lower this? Unfortunately, you can't do a lot of stuff in a prior year. So that's where planning and preparation kind of meets at ahead. A CPA, a certified public accountant, their job is to, it's embedded in their name, to account for what happened in the prior year. And I think where planning and preparation really meet is when you look at a return, you oftentimes can look at a return and go, okay, what could I have done differently in the prior year so that way I could have lowered my tax bill, or I could have mitigated that tax bill so I don't make that mistake again. And so with that being said, tax planning is about strategy. It's about understanding where you fall in within the marginal tax systems and really capitalizing on that. So you kind of get as much out of the system as you possibly can, and really you get as much in your own pockets and not the government's that you possibly can. Tax planning is a way to take advantage of a lower tax rate today versus waiting to pay taxes at a potentially higher rate in the future. There's so many strategies that we're going to talk about later today, but you might have heard of things like Roth conversions, tax loss harvesting, tax gain harvesting. It does, most people don't hear about that. Managing qualified charitable distributions, charitable giving. Tax brackets really determine the different ranges of how income are taxed. And so by focusing on where each dollar of income falls into each bracket, you can potentially lower your taxes over your lifetime and maximize your after-tax wealth. So like I teed up a minute ago, we're going to start at ground zero, and we're going to start by talking about the marginal tax system, understanding how the marginal tax system works. After we go through a handful of these slides, I'm actually going to bookend this by looking at a true 1040 tax return, which most of you will fill out, and seeing how it all kind of comes into fruition together. So in general, ordinary income tax rates or brackets apply to all income, unless otherwise specified, such as like long-term capital gains. Ordinary income normally includes wages, income from self-employment, businesses, rental income, interest, ordinary dividends, short-term capital gains. I don't know if any of you guys got on the GameStop bandwagon, but if you buy and sell a stock for a profit in less than 12 months, you're going to actually pay ordinary income on that gain, not capital gains, which will be here on the next slide. But what I want you to look at on this slide in particular is kind of how the tax system operates. A lot of people will tell you, coworkers may commiserate, oh, I'm in the 32% tax bracket. And they're under the assumption that all their income is taxed at 32% or maybe 24%. But if we want to look on the married filing jointly on the right side of the screen, what I want you to really look at is what we operate under is what's called a marginal or progressive tax. So all folks will pay 10% of, they're on this situation, like looking at the married filing jointly, they'll pay 10% against their first $22,000 of taxable income. Then they'll pay 12% from the 22 to the 89 range, called 70 grand. You can kind of see how it works. So marginal tax is where your last dollar ends up. So if your last dollar of taxable income is around $365,000, you're really only paying 32% against that, a little above and beyond what's over 364,000. And so that's what's called an effective tax rate. Your marginal rate is kind of where your last dollar falls. So someone making 185,000 would have a married filing jointly would have a marginal tax rate of 24%, but their effective, what we call an average tax rate, might be much lower. It might be somewhere in the teens. Okay. So that's ordinary income. The next part of your income is long-term capital gains and qualified dividends. Long-term capital gain tax rates and brackets generally apply to like investment assets held for over a year and to qualified dividends. There's also a special net investment income tax, the NIIT tax of 3.8% that may apply to certain investment income like dividends or interest and long-term and short-term gains. So some people are like, oh, I'm in the 20% capital gain bracket. You may in fact be in the 23.8% capital gain bracket. It just depends on your income and how things fell that year. Certain dividends, we kind of touched on this, but I want to kind of camp out for a second on it. Certain dividends are known as qualified dividends, are subject to the same tax rate as long-term capital gains, which as you see here are 0 or 15 or 20%. Okay. These are generally dividends from shares in like domestic companies or certain qualified foreign companies that have been held for a specified period of time, known as called a holding period. But again, these are long-term capital gains rates and qualified dividend rates. If they don't meet these criteria, they haven't been held for over a year, they're subject to short-term capital gains rates, which again is ordinary income. So you want to be very mindful when you're doing tax planning and you're going to sell something for a profit. What are the tax implications of that sale? Are you going to be taxed at 15% or 32%? and that could be a wildly different number, and really impact a lot of other parts of your financial plan. Then we're going to go into deductions. So we've got income, we've got ordinary income, we've got capital gain income. Now we start chipping away at that bill. So how do we do that? Well, we start by just kind of understanding how standard deductions work. The standard deduction effectively creates a 0% tax bracket because it reduces your taxable income dollar for dollar. In general, you can either take the standard deduction or the itemized deduction, but you can't take both. Okay. So these are the standard deduction numbers for 2023. If you're single, married, or filing separately, you get to chop $13,850 off your income, $27,700 married filing jointly. And if you're over 65, you get an extra $1,500 a person. Over 65 and unmarried, a little bit more. And there's also different criteria if you're blind and such. But these are the standard deductions. Now, when these got elevated several years ago, most folks fall into the standard deduction camp. But we're going to talk about strategies later in this presentation where some people they do charitable giving or different strategies that actually allow them to itemize their deductions, and in doing so they reduce their taxable income. So it's the greater of the standard deduction or itemizing your deductions, but not both. Other deductions to think about. These are some that come up quite a bit. People have questions a lot now that student loans are kicking back into gear. Obviously they started in October. Tax deductions reduce your taxable income dollar for dollar, whereas tax credits reduce your tax liability dollar for dollar. Generally speaking, tax credits offer larger tax benefits for income in lower brackets, and tax deductions give larger benefits for people in higher tax brackets. So lower tax bracket, tax credits help. Higher tax bracket, tax deductions help. Deductions really, they just reduce the amount of your income before you calculate the taxes you're owed. Credits reduce the amount of taxes you owe, or they could actually increase your tax refund. Certain credits may give you a refund even if you don't owe any tax. And so that kind of at a high level explains some other common deductions and credits that don't actually require you to itemize. Okay. So I want to go back a few slides. We talked about ordinary income. And the reason I put that red line there, I might have missed this, but I put that red line there because you can see really clearly that's a massive jump. A lot of folks go from 12 to 22 to 24, and then there's a leap from 24 to 32. So for a lot of our folks who are, high income earners, that's the number we really want to push against, because that's a large hurdle, to go from 24 to 32%. So we're very cognizant for a lot of our clients who are maybe exercising stock options or things like that. I hate giving away a third of any client's paycheck to Uncle Sam if we can avoid it. So we kind of went over the marginal tax, what considers ordinary income, long-term capital gains and qualified dividends, standard deduction, it's the greater of the standard or itemized, but not both, some other deductions and credits. Okay. So now what we're going to do is look at a 1040. You may have to zoom in a little bit here. I know this is a lot, but what I wanted to put on your screen is a 2022 1040 individual tax return. Okay, so what is a 1040? What is an IRS Form 1040? It's formerly known as an individual income tax return. It's the standard federal income tax form people use to report income to the IRS, claim deductions and credits, and calculate their tax refund or tax bill for the year. The IRS releases a revised version of this form for each tax filing year. People who have a fairly simple tax filing situation may not need to file anything other than the standard form. But if you got more things going on in your tax life, like you may have to get a hold of additional forms called schedules. We'll talk about schedules here in a minute. But those will go alongside your 1040. Schedule A, for example, I might have touched on this a second ago, is a tax form familiar to those who do itemize deductions on their tax return instead of taking the standard deduction. And I know this form can look complex. There's so many, it's generated by the IRS, so I doubt it's leisurely reading. But we're going to boil this form down into 4 simple parts. On the top left, it's just asking who you are. Really, they're just trying to figure out who you are, what's your filing status. Are you single? Are you married? Okay. Do you have kids? Do you not have kids? Do you have dependents? Do you not have dependents? But All the top left corner is asking is who you are. The second section on the bottom left is figuring out your income. That's all we're doing here. The form 1040 gets busy tallying all of your income for the year and all the deductions you like to claim. The objective of this section is just to calculate your total income, then deduct various items like retirement contributions, HSA contributions, and that's going to get you to your adjusted gross income. Okay, so we have total income, we have adjusted gross income. That's after the 401ks and HSAs are considered and some other things. Then you're going to subtract either the greater of your standard deduction or your itemized deduction. Okay. Finally resulting, after all these things have been whittled down, finally resulting in your taxable income, which is the amount of income that's subject to income tax. You or your tax preparer or the software, if you use TurboTax, will then consult the federal tax brackets to do the math. Okay. The third section, calculating your tax liability. Near the bottom of Form 1040, you'll write down how much income tax you're responsible for. At that point, you get to subtract any tax credits you might qualify for, as well as any taxes you've already paid via withholding taxes on your paycheck or maybe making quarterly estimated payments along the way. The last part, under payments, determines whether you've already paid some or all of your tax bill. It helps you calculate whether those tax credits and withholding cover the bill. If they don't, you may need to pay the rest when you file. If you pay too much, that's where you get a refund. You see a little refund slug in the middle. Okay, so Form 1040 even has a spot for you to tell the IRS where to send your money. You can see there now they include the routing and account number if you want to send it to your bank or checking or savings. So I'm going to go through this form with you, and I just want to look at it one little red box at a time. When you look at a 1040, I want to kind of simplify things. Some of these areas I'm going to skip because a lot of them aren't pertinent to some clients. Like like tip income is not common for some of our clients. But the first box you see here, that's just your W-2 total amount. So if you're a W-2 employee, your wages are going to go right there. Okay. If you have investment assets in brokerage accounts or maybe CDs, a lot of you bought I-bonds in the last 12 to 24 months. This is where you'll see Schedule B. Schedule B is a schedule for your interest and dividends, and the net result of Schedule B is going to flow through to this spot right here. Okay, so some of your interest will be taxable, some will be tax exempt, some of your dividends are qualified, some will be ordinary. We've kind of talked about that a little while ago. That's where Schedule B will flow through. A lot of our clients have these boxes filled out in their tax returns. And I'll tell you, just kind of teasing it towards the end of the presentation, this is where we often find so much opportunity to save clients money on taxes. We'll get into asset location and allocation here in a little bit, but oftentimes we find that investors are holding the wrong types of investments and the wrong types of accounts and inadvertently paying way too much in taxes just by having let's say, for example, a mutual fund in their brokerage account and not inside of their IRA. That's where this part would flow through on their return. The next part is their capital gains schedule. So this is where Schedule D is where you report your income and your capital gains, and the net result will flush out right there. So when I look at this section, sometimes I'll see a ton of capital gains. I'm like, well, that's interesting. Like let's further examine their return. Let's look at their prior year trading history and see if there's anything we could have done maybe more tax efficiently to save clients down the road. The next part is your total income. So we've added all these things up, 1 through 9. And that's where we get our total income. You just add it all up. That's pretty simple. Okay. And then the next part is determining, do we want to take a standard deduction or an itemized deduction? And that's right here. So we subtract either the greater of the standard or the itemized. Okay. And that's where this flows through right here. And that, after that adjustment is made, you get to your adjusted. I'm sorry. Once you do certain deductions, this is like 401k. I apologize. That's 401k contributions, HSAs. That gets you to your adjusted gross income. After your adjusted gross income, we choose the standard or itemized deduction. That's under Schedule A. And that's essentially when you net that out, that gets you to your taxable income here at the bottom. Once you've identified your taxable income, we can then start figuring out what your total tax bill is going to be. Okay, where do you now fall within the marginal tax system. We'll go all the way back. Are you in the 12, the 22, the 24, the 32? This total tax number, this total income number, taxable income number, is going to dictate what that total tax liability is going to be. And this is going to show this last section right here. This little payment section shows what you withheld from your 401k, from your paycheck, or if you've made any quarterly estimated payments, and we'd be left with either a refund or an amount we owe. So I'm going to stop there for a second. Just at a high level, say you guys have now successfully walked through a 1040 tax return. It's money in, money chipped away, and then what our tax bill is going to be. I say all that to say, when we are meeting with clients right now at this time of year, we're doing this for all of our clients. We want our clients to know what that total tax obligation is going to be in October, November, because we've got until 12/31 for a lot of folks, and maybe longer if you want to put money in certain retirement accounts to mitigate that. If you want to lower that tax obligation, we want to make sure we do so with plenty of runway before the year end. And so I use this analogy around the office, and people give me a hard time for it, but if I'm going to I have a 6-year-old son, I have 3 boys. So if my 6-year-old son comes up and I'm not expecting it, let's say I'm watching a football game on the couch and he hits me in the shoulder and catches me off guard, it's going to startle me, but it's going to hurt. I mean, he hits hard. But if my 6-year-old tells me in advance, hey dad, I'm going to kind of punch you in the shoulder, I can brace for it. I can prepare for it. It still hurts, but it hurts a lot differently. It hurts a lot less. And I feel like taxes are the exact same way. If you know, hey, in 3 months I got this bill coming, you can prepare for it. You can maybe make some adjustments in your portfolio. But we never want our clients to be caught off guard, and we never want them to be blindsided by a tax bill come April or maybe later if they've extended. So how does this impact you? Okay, how does this impact your financial plan? At Aspen, we firmly believe anyone can benefit from tax planning. And almost everyone who can benefit from tax planning, no matter what your current tax bracket or situation is. Tax laws are always changing, and whether you make $80,000 or $800,000, there are strategies that you can likely execute to mitigate your tax bill, both in the current year and over your lifetime. And we look at that from a different perspective. There's intra-year tax planning. How can I save as much money this year? But also, how can I save as much over my lifetime? Right? And that's where things like Roth conversions may come into play that we're going to talk about here in a little bit. Once you know your marginal tax rates, you may find that you can fill up that tax bracket with more income without pushing yourself into another high bracket. For example, investors who are currently in a lower tax bracket than they expect to be in the future, like when they expect to make taxable withdrawals from their retirement accounts, can potentially benefit by filling up their current tax bracket this year by doing things like Roth conversions or tax gain harvesting. Whereas some investors are in a high bracket year, they're in their peak earning years and they know they're going to retire in a few years, so they may find it beneficial to lower their tax bill by maxing out their 401ks in pre-tax fashion, dumping money into health savings accounts, or giving strategically to charities in the form of a donor advised fund or lumping gifts, as we like to call it. So in light of your financial plan, what we do at Aspen is comprehensive financial planning. Our job is relatively simple. We want to live anywhere your life and your resources intersect. And so with that being said, taxes are a key component or a lens in which we review your financial plan. It's not uncommon for us to meet with folks, and let's say you have client A who needs $120,000 to maintain their lifestyle, and client B who needs the exact same amount. With proper planning, and let's say without proper planning, some folks come to us and they have all their money in their 401k pre-tax and they've got some cash. When they need to retire, they're likely going to, it's going to be really hard to do a lot of tax planning and strategy because every dollar they spend is pulling on pre-tax assets. Versus client B maybe has money in non-retirement accounts or brokerage accounts or Roth accounts. They can still live a $120,000 lifestyle, but maybe from a taxable income standpoint, the IRS thinks they only make 80 grand or 60 grand. And that's what we really want to help our clients operate under if at all possible. So step 1, where do we go from here? Determine your tax brackets. The first step in tax bracket management is to estimate your current year income and identify your marginal tax brackets, ordinary income and long-term capital gains before the year end. Okay? consider working with your tax professional or your financial planner around this time of year, so October to November, to do this, as you'll likely have a fairly accurate sense of your total taxable income. Maybe you have a bonus coming, or vesting of stock or something like that. Most of our folks in October, November kind of have a pretty good idea of what they're going to be making for the year. You need to project taxable income for the purposes of protecting two marginal brackets: your ordinary income bracket and your long-term capital gains tax bracket. For federal taxes, ordinary income generally includes wages and income from a business, and we already talked about this, whereas long-term capital gains come from investments that have been held and sold after a year or more, and they've appreciated in some value. Investments held less than a year and sold for a gain, like we talked about, are short-term capital gain, and they're taxed as ordinary income. And we've kind of gone through all those, brackets like we talked about earlier. To illustrate, I want to look at an example here on the screen. We're going to call this client Jane. So Jane is single, and she lives in Florida, another state. Yay for no income, no state taxes at least. She has total ordinary income of $82,950. You add up all those blue boxes on the top, that's what you're going to get. $82,950 from her job, and she has no itemized tax deductions. She uses the standard deduction. Again, she's single, so standard deduction of $12,950 for single filers. That's going to lower her tax bill to $70,000. I apologize. If you add all the blue up, her taxable income is $70,000. So it's $82,550 minus the standard deduction. She ends up with a taxable income of $70,000. We also assume that she has $10,000 of long-term capital gains from the sale of some stock. Okay, so let's look through this together. Her taxes are the first $10,275, the first $10,275 are taxed at the 10% tax rate, which equals about $1,028 in taxes. From $10,276 to $41,775 of ordinary income, she falls in the 12% bracket, which results in a $3,780 tax bill. Okay. Next, in ordinary income, again, from $41,776 to $70,000 of taxable income, she's taxed at 22% for approximately $6,210 in taxes. Finally, her $10,000 long-term capital gain income is stacked on top of her $70,000 of ordinary income, and this means that the gain from selling her stock falls into the 15% long-term capital gains bracket, which results in a $1,500 tax bill. So Jane pays a total federal tax bill of $12,517. This makes her effective or average federal tax rate 15.1%. And really, to calculate that, is simple. You take your total taxes paid divided by total income. Her marginal rate is 22%, and her marginal long-term capital gain rate is 15%. So this is a perfect illustration when you hear someone say, oh, I'm in the 22% bracket. Well, Jane is too, from a marginal tax bracket standpoint, but her actual effective tax rate is 15.1%. Step 2. Under here, we've determined your tax bracket. We understand in November what your spring bill is going to be. Okay. What can we do to mitigate it? Manage your brackets. These are tax bracket management techniques. There are more, but these are the ones we're going to cover here today. If you have relatively low taxable income in a year and believe that you'll be in a higher tax bracket in the future, or if you're in the unique situation of being able to realize capital gains at a 0% tax rate, well, then it may be prudent for you to fill up your current tax bracket with more income without pushing yourself into the next higher bracket. This is a tax filling strategy, okay? You may also be able to take additional deductions or make tax-deferred retirement contributions to pull yourself down into a lower bracket. You can do this using several strategies seen here on the screen, okay? But by focusing on where each dollar of your income falls into each tax bracket, you can then potentially lower your taxes over your lifetime and maximize your after-tax wealth. So we're going to kind of go through these one at a time. Now, you've probably seen this same slide or this same image on a prior webinar I did before, but to be frank, I spent a minute on it. I knew we'd be doing this webinar in time, so I wanted to make sure I got through that presentation without boring too much of you guys, but since you're all logged in and wanting to learn about taxes, here we go. So filling up a tax bracket, very, very common technique for a lot of our folks who retire and they've got a number of years until they hit Social Security. So maybe you retire in your early 60s or early 50s, or maybe you're starting a business and you know you're not going to really make a lot of income for a few years. In years where you have lower income, it may be very prudent to execute Roth conversions. Roth conversions is a technique where you take money from a pre-tax retirement account, like a 401k or an IRA, and you transfer that money into a Roth IRA. And what you're saying and what you're betting on in that scenario is, hey, I'm willing to eat the tax bill for this conversion. Because when it goes from pre-tax to Roth, that's a taxable event. You're adding it to your taxable income. But what you're saying is, hey, I identify that I'm in a low bracket this year. I'm in the 12% bracket or the 22% bracket. I'm going to go ahead and eat that tax bill. And I'm going to pay those taxes, hopefully with cash in the bank or non-retirement assets. But I'm going to bet that when I need this money or the compound interest and the tax-free growth that you get from Roth, it pays off in the end. And so a lot of our clients, they come to us and Roths haven't been around for that long. And so maybe they got a ton of money in pre-tax, but they retire in their late 50s or early 60s. What we want to do is identify every October and November, hey, where are you at in the marginal tax bracket system? Do we have another 12,000 or 24,000 we can maybe convert from your pre-tax to your Roth? And that's going to do a lot of things. It's for someone who's really pre-tax heavy. When we talk about buckets of tax buckets, it's not only going to shift money from pre-tax to Roth, but it's going to mitigate their required minimum distributions that they take down the road. We're going to talk about those RMDs here in a second. But by shifting money from pre-tax to Roth, they're also mitigating their estimate, their RMDs they may have to take down the road. And that can be a great strategy for long-term planning and kind of squeezing as much of the tax system over your lifetime. Qualified distributions. If you can't get all your money out of pre-tax, and it's healthy to have pre-tax money, so we're not sliding that. Some folks don't need all their RMDs. So let's hypothetically say you got a couple, and between their retirement accounts, they've got like $100,000 in RMDs. They don't want to take them, or they don't want to take all of them. What you can do in lieu of taking a required distribution, okay, is you can send that money directly to a charity. And so you can actually bypass the RMD. So it satisfies your RMD requirement. Let's say your RMD requirement is 100 grand, but you want to send 10 or 20 grand to your church or charity. You can say, hey, Charles Schwab, or hey, Candace at Aspen, will you go ahead? I don't need all my RMDs. Will you send a check directly from my IRA to the church? And when you do that, you satisfy your RMD requirement, but you don't pay taxes on any of that money. So a qualified charitable distribution is a great strategy. Tax gain harvesting, it's identifying, there's a 0% long-term capital gain bracket. And so I'm going to briefly touch on that, but we're going to go through an example where it actually makes sense for someone to sell stocks with a capital gain, knowing, they can only sell so much until they actually jump from 0% to 15%. So we'll talk about that strategy here momentarily. Okay, so that's filling up a bracket. But a lot of you guys aren't wanting to fill up your brackets. You're saying, how do I trim my income? How do I pay less in taxes? And for you folks, what we talk about are like these different strategies you see here. Tax deferred retirement contributions, maximizing your 401ks or your 403bs. It's often we look at a return and we see like an HSA contribution for like $1,000 when you can give much higher than that for an individual or a family. So that's low-hanging fruit, maxing out HSA accounts, maxing out pre-tax vehicles like your 401ks. And then like we talked about, charitable giving, like bunching or gifting appreciated assets. For those who are charitably inclined and want to offset income for maybe a Roth conversion or just mitigate their taxes altogether, charitable giving can be a great way of doing that. We have a lot of clients who they love to give to churches and charity. And so what we identify is, and for those who tithe to their church, for example, on a monthly basis. When you're working, a lot of people say, okay, I'm going to tithe 10% of my income, or they have some anchor that they feel comfortable with tithing a percentage of their income or a certain dollar amount. But then you ask them, hey, when you retire, how much are you going to tithe to the church? Because you have no more income. And you'll see them kind of sit there and they don't know. And it's an honest question and conundrum to kind of be in. So we really help our clients who are nearing retirement, maybe 3 to 5 years prior to retirement, identifying how much they want to continue giving to charity, right? In retirement. And maybe it makes sense to lump or front load their charitable giving into a donor advised fund, also known as a DAF, while they're working, while they're in the highest marginal tax brackets, or their taxable income is the highest it's ever been because they're kind of in their peak earning years. And so we front load this donor advised fund, immediately receive the tax deduction. And then when they retire, that's what they give to their church and charity out of. That becomes kind of their quasi tithing account. So they accomplish the same thing. Their church will never, get any dollar different. But what they're doing is they're realizing the tax benefits by kind of front loading their charitable giving during their peak earning years. And then they'll use that account to tithe out of in retirement. And then maybe they use a combination of their donor advised fund and qualified charitable distributions like we talked about later down the road. Okay. Tax loss harvesting is another common strategy. Those who have recognized net capital gains can sell investments with losses to reduce that capital gain tax. So I use this analogy all the time. What we ideally hope to do for clients when they retire, let's say they got a baseline of income from Social Security or a pension, and then they have money coming from, we give them, I don't know, $4 or $5 grand a month from their pre-tax sources. But we're really trying to make sure they don't go into the next bracket. Well, then throughout the year, if they have any ad hoc kind of large disbursements, like a car, air conditioning unit, travel, maybe we pull that from their non-retirement brokerage accounts. And so hypothetically, I have a client who says, hey, I need 20 grand for whatever they need 20 grand for. What I'd like to do is go find $10,000 worth of capital gains, long-term capital gains, maybe $10,000 worth of long-term capital losses. I can take 10,000 of gains, 10,000 of losses, we can offset each other, and they essentially get a tax-free $20,000 in their hand. That's a great way to think about where tax planning and retirement income planning kind of meet and intersect. So these are some common tax bracket management techniques that we try to execute for a lot of our clients towards the end of the calendar year. Okay. We've got filling up your tax bracket, Roth conversions are the common one there, maybe tax gain harvesting, reducing taxable income, can be putting money in those tax deferred HSA or 401k or 403b accounts. And then for those in, at or near retirement, maybe lumping gifts into a donor advised fund. And for all clients along the way, tax loss harvesting is a very, very powerful technique to increase your, essentially mitigate your taxes over time. Okay, so we're going to go over 2 examples. And I want to make sure we cover 2 that are very different from one another. But this is a common one of reducing taxable income. In this scenario, we're going to use some tax loss harvesting, some HSA contributions, and some retirement savings. We're going to kind of throw the kitchen sink at this guy's plan and see what we can do to mitigate his tax bill. Like many of you, if you're a client of Aspen, mitigate your taxes is something that's top of mind for you. So unlike Jane, we're going to call this guy Rick. This is Rick. Everyone meet Rick. He's a seasoned professional, just a few years away from retirement. And he's on track to make about $220,000. Now, I'm going to use 2022 tax numbers because that's when I put this together. But we'll use $220,000 in 2022, but the principal will stay the same. Rick is single, and he plans on taking the standard deduction of $12,950, along with his 10% contribution to his pre-tax 401k. $220,000 times 10% is $22,000. His taxable income is expected to be $180,050 for the year. Okay, 220,000 minus 22,000 minus the standard deduction, 12,950. That's going to push him into the ordinary income bracket of 32%. If he keeps his taxable income under $170,050, he can avoid the 32% income tax on income over that amount. So Rick could accomplish this by reducing his income by $10,500. Again, he's already used $22,000 into his 401k. So let's see what techniques we can execute that are already on the screen. Among the strategies available, he can increase charitable contributions. He can increase his pre-tax or HSA contributions, or he can offset his income through capital losses, long-term capital losses. So Rick decides to max out his 401k, limited to 22,500 per year, but he has an additional catch up of $6,500 because he's over 50 years old. So he can contribute an additional $5,000. He also decides to max out his HSA account, which back then you could do $3,650 for an individual. Knowing that he can also use $3,000 in net capital losses to offset his income, Rick decides to sell some taxable assets with long-term losses, locking in $1,850 in capital losses that can be used to offset his taxable income. The three strategies we described brings Rick's taxable income to just under the threshold, allowing Rick to remain in the 24% marginal bracket. Okay. Now, again, it's $10,500 he was over, and that's what's taxed at the 32% tax rate. But by using three very simple strategies and catching them kind of later in the year, we were able to push him back down to where he pays nothing in the 32% bracket. His highest marginal bracket is the 24% bracket, which is a win for Rick and I guess a loss for the IRS, which we're happy with. Our next strategy here is managing taxable income. So managing reduced income in retirement. It's not uncommon for us to work with folks, and some of you I know for a fact are on this call, where you get to retirement and you've never been richer in your lives. You're the wealthiest you've ever been, but you also are in the lowest tax bracket you've been in quite some time. Okay. It's because you're retired. Your ordinary income is next to nothing now. I mean, so you've got maybe Social Security, you've got, some of y'all have a pension, but any ordinary income on top of that is from, it's really from pre-tax withdrawals, right? And so it's a great spot to be in. And while you're in those years, we can do things like Roth conversions, or we could do tax gain harvesting, which we're about to see here. But this is a common situation, for a lot of our clients who are in that early to mid 60s, or maybe even earlier, but they're not quite at Social Security age, and they've had more money than they've ever had in their lives, but their income has never been lower as well. Okay. So in this example, we've got John and Sarah. They're married and filing jointly with $82,900 of total income in 2022, which results in taxable income of $67,000. Again, that's $92,900 of ordinary income minus $25,900 for the standard deduction. They also have a stock and a long-term capital gain that's appreciated by $25,000 that they'd like to sell over the next few years to fund some home improvements. Okay. They recognize their current taxable income of $67,000 resides in that 0% long-term capital gain tax bracket. If the couple, if John and Sarah can be flexible with the timing of realizing the gains they need from their brokerage account, knowing that any unrealized capital gains may with future market performance change, they can limit the sale of their shares to $16,350 to avoid selling their shares at a 15% long-term capital gain rate. So of the 25,000 potential realized gains, 16,350 would be taxed at 0%. Okay. So in 2023, when they expect to have similar income, they could just sell the rest. They got 25,000 in gains. We say, hey, let's sell 16,000 some change, or maybe 15,000 to be safe, and some change in December. And let's just sell the remaining slug in January. And we'll break up that sale over 2 different tax years and keep those capital gains to a 0% tax bill. And so that's a very huge savings for this couple. And any dollar counts, right? And so if you could save 15% against 16,350, and they're using this for home improvements, maybe it buys them a nice chair for the extra room they're adding on or something. So every dollar counts. So these are 2 different examples: reducing taxable income, and maybe capitalizing on being in a low bracket for those who are retired early or in a reduced income situation in retirement. So these strategies, they're all fine and good. But I will tell you from experience, they should come with some considerations. Okay. Some people get overzealous with things like Roth conversions. And what they do is they convert way too much, and they inadvertently throw off things like their Medicare premiums. We've had a whole webinar talking about IRMA surcharges. They can convert so much so soon that they actually throw off the Social Security income. They actually become taxable on some of their Social Security. And so what I'd say, some considerations to consider with tax planning: realizing additional income can be complex and have an oversized impact on your total tax bill. If the extra income pushes a larger amount of long-term capital gains into the next higher capital gains tax rate, maybe consider holding off on that for this year. To truly optimize these strategies, we recommend working with a CPA or an enrolled agent or a certified financial planner like our team at Aspen who are well versed in tax planning. Do some calculations and target specific dollar amounts and where you fall within those brackets. Like I talked about, boosting your taxable income can also increase the percentage of Social Security income that's taxed. If your combined income equal to adjusted gross income plus non-taxable, there's a whole calculation there, but it's about $34,000 for an individual and $44,000 for a joint return. You can actually increase the taxable amount that you're paying on Social Security, which is something we don't want to inadvertently do by just, selling something at a profit. Lastly, boosting taxable income can cause the phase out or complete disqualification of certain deductions. So as the qualification of various credits and deductions is determined on these, what they call like these phase out bands of your income, we just want to make sure that if you pull, this certain lever on the tax planning strategy, that you don't inadvertently trigger a lever on the other side that you could have benefited from like a deduction or a credit. So bottom line, effective financial planning and wealth management is much more than just investment management. Okay. Like we mentioned earlier, our job in its simplest form is to live anywhere your life and your money intersects. Okay. And a large component of that is understanding all of our clients' tax situations. I'll kind of die on this hill, but one of the reasons we're so adamant at Aspen of never going the investment management route, and then I might be talking inside baseball here for those who aren't clients of Aspen, but all clients of Aspen start with a comprehensive financial plan. We will not invest a penny of a client's money until we've gone through a comprehensive financial plan because we firmly want to know what their income tax situation looks like. To being a fiduciary to us means making recommendations in light of their entire financial plan. And so the investments in your investment profile, your net worth, are designed to support your financial plan. But your taxes are a major component there. Okay, so by using different combinations of tax planning and investment management or retirement income planning, you develop a more robust and comprehensive financial plan. And hopefully that by doing so, you'll also mitigate the taxes you pay throughout your lifetime in retirement. So thank you guys so much for being on here. We've got a handful of questions, so I'm going to kick it over to Candace. She's going to read off those questions that'll come through, but I sincerely appreciate y'all being so patient as I talk into a microphone for 50 minutes.
Yeah. Jim, that was great. Thank you for doing all of that. Prior to the meeting, we had a couple people submit some questions. So I'm going to pose those to you, Jim. And everybody, if you do have questions, there is a chat feature or a Q&A feature in Teams, and please feel free to jump in and add those. Okay, so let me see. Oh, this is a good one. So how much do I withhold from my pension or my IRA whenever I take distributions, given all this information?
Yeah, that is a great question. It depends. Like all things, the politician's answer is it depends. If you intimately know your tax situation, I mean, let's say you know you're selling a piece of property, or you kind of know where you stand. I'd say let that be your guideline. So the tax tail kind of wags the dog there a little bit if you're using pre-tax assets. But as a general rule of thumb, we want our clients withholding the effective tax rate from the prior year. Again, not the marginal rate, their effective rate. That's the average rate. So we talked about, I think Jane was the client we came up with in the case study. Her marginal rate was 22%, but her effective rate was about 15.1. So for a client like her, maybe we withhold 16 or 18% just to kind of give her a little bit of buffer. But we want you withholding as your effective tax rate from the prior year, assuming your income looks similar from the prior year.
Okay, that's great. Okay. Here's another one. How much can you give to children each year and not have to file a gift tax return?
Yeah, that is a very common strategy a lot of our clients execute. One part we didn't talk about today is my background I love is estate planning, is what we call like lifetime giving. We have a lot of clients who don't necessarily want to, let me just say, you don't get to take it with you when you go. So if we think about wealth from that standpoint, And so they call it a living inheritance. They want to see their kids enjoy maybe their inheritance throughout their lifetime. So rather than give kids all their money upon their passing, maybe they give their kids money to take their kids to Disney World or things like that. That's where this comes up. So you can technically in 2023 give $17,000 to anyone you want and don't have to file it on your tax return or you file your gift tax form or anything like that. So 17,000 is the number for 2023 per person. So for a married couple, you could give $34,000 per year. So my wife and I theoretically could give $34,000 to anyone we want, and we don't have to file that on our tax return. And so this can be a great strategy for clients who want to maybe help their kids and also kind of maybe do what's considered like a living inheritance, where they see their kids actually enjoy their wealth and their inheritance throughout their lifetimes.
Oh, here's a good one. Is a charitable gift a dollar for dollar income deduction?
Is a charitable gift a dollar for dollar income deduction? Typically, no, but it depends on your tax situation and what you're gifting. So when you donate cash to an IRS qualified 501c3, so a lot of times this is churches or nonprofits in your community, you can generally deduct up to 60% of your adjusted gross income. So again, if you're giving cash, you can generally deduct about 60% of your AGI, okay? Provided you've held, however, one thing that we encourage clients to do as they get, in retirement or later in years is maybe not gifting cash, but gifting appreciated stocks or securities. So maybe you have stock options from a company and they have these huge embedded gains. Well, you're never going to sell, or you don't want to sell them because they have these large capital gains embedded into them. So rather than tithing or giving to charity with cash out of your bank account, what if you gave the same dollar amount through highly appreciated stocks? The church is going to get the same amount, or the charity is going to get the same amount. And so for those folks, provided you held them for more than a year, appreciated assets, including long-term appreciated stocks and property, are generally deductible at fair market value when they're gifted, up to 30% of AGI. So 60% for cash, 30% for highly appreciated stocks. You can also combine them, but that's a fun conversation with your CPA and how you do that. But by and large, it's not dollar for dollar, but 60% of what you give, you can give up to 60% for cash and deduct it, and 30% of your AGI with appreciated assets or securities.
Thank you. Oh, okay. This one's a little bit more specific. Jump in if you want to answer it, Jim, but otherwise, I'm going to take a crack at it. So this one is specific to solar panels, and you've probably had those people come by your house and try and sell solar panels, and they tell you, oh, you're going to get a tax credit, and whatever money you get back, you can pay off the solar panels. And we recently had this question come up, and so even though you do get a tax credit from solar panels, it's a carry forward credit. So it's not one of those that you can put on your tax return and it's going to make you receive $10,000 or something back into your pocket. It's one of those that you're going to have the tax credit. And if it's completely offset, whatever your tax liability is, it's just going to carry it forward to the next year. And so it's not something that's going to give you any money back. Did you have anything to add to that, Jim, or?
No, that's right. And no, that's exactly right. I know internally in the firm, I have not had a client buy solar panels recently, but I know it comes up quite a bit with all the new developments. And Dorothy and Tom, I see your question. No, that $17,000 gift does not reduce your income taxes. It is a non-deductible gift, but it's a gift, but it's something you don't have to claim or put on your tax return, but it does not reduce your income.
Mm-hmm. Yeah. Any other questions while we have our tax expert here?
No. All right. Well, guys, thank you so much for your time. We want to be respectful of the hour. We sincerely appreciate those who have joined. I know several have asked for this via recording, so we'll be sending this out as well. All these webinars are available on our website in recording form. We also have them on YouTube. So if you want to circle back and watch any other questions, there's a webinar very similar to this one about tax efficient withdrawal planning in retirement. So if this was interesting to you and you want to kind of figure out, okay, how does this information flow through to like actually withdrawing income in retirement, I'd encourage you to watch that one as well. But our information again is available on the back end. Let me share that again. So Candace and Maya's emails are right here, as well as our website. If you do have any questions, please do not hesitate to give us a shout. We kind of geek out on tax stuff, so we're happy to help with any questions you may have.